Hi everyone. I had originally planned on releasing the video that I recorded yesterday evening during my office hours where I did a mini lecture of Chapter 10, part of Chapter 10, using these slides that you see here. However, when I went back today, a couple things. One, it was a 2-hour video, and I planned on cutting an hour of it because an hour of it was going through the problem. And I told those guys last night I would just do a separate video and work through the problem again, because we actually had technological problems last night with the problem. But the 1 hour, which pertains to the slide walkthrough, the lecture part, did not record well. So there seems to be some sort of issue with the new headset that I just bought. And now I'm just doing it the old-fashioned way, where I sit in front of my computer and I talk. And that always seems to work great. So I may be switching up how I conduct office hours. I'm going to think about it today, tomorrow, and I'll let you guys know. But likely my office hours are going to be relegated to problem work through and basically talking through issues that students have, just like you would normally do in office hours. I probably am not going to lecture anymore because it ends up being double work for me, like right now when I have to now redo the video. Not that I don't love you guys, but anyway. Okay, well, what I did last night was before I launched into the discussion of non-liquidating distributions using these slides, I did a quick overview of basis and how basis is established and what increases and decreases basis throughout the year in a partner's interest in the partnership. Because I feel like a lot of the class is not real strong in that regard with regard to definition of basis. So, first of all, how do we establish basis in anything? Well, the way that we establish basis and what basis is it's defined as the amount of money or property that you use to buy another piece of property. And let's say that you buy a piece of property for $30,000, and that property is partnership interest in a partnership, and that's property. Okay, that's an investment in a partnership, so it's property. It's kind of like stock, right? If you bought stock in Microsoft, that's property, that's capital asset, and so is a partner's interest in his partnership. That's property. So if you bought a partnership interest for $30,000, you have established basis in that partnership interest of $30,000. That's your beginning basis. However, you may have additional basis at the outset, i.e. when you buy the interest, if there were any liabilities in the partnership for which you get a share of. So the rules in Chapter 9 tell you that sometimes a general partner or a limited partner might receive a share or be responsible for a share of the liabilities of the partnership. And that essentially means that if the partnership has to repay the liabilities and the partnership itself cannot pay those liabilities, they can come to the partners to get relief from those liabilities, and the partners would have to pony up personal assets to repay the liabilities. So if that's the case, they get basis for that. They get to increase their basis in their partnership interest in the partnership, because if and when they ever need to pay those liabilities, you know, economically, the IRS wants to even it out for them. So if they have to pay out some money out of their personal funds, then they should have the right to increase their basis in the partnership interest. And the way to look at that is if you sell the partnership interest in a subsequent year, in a year after you've increased it for those liabilities, you will actually have less of a gain than you would have if you had not increased your basis for that share in the liabilities. So that's how you economically come out, even Steven, if you will, when you have a responsibility for paying back liabilities of the partnership, is you get basis for them. Now, you'll get beginning basis equal to whatever the beginning, your percentage share of the liabilities of the partnership are at day one when you buy into the partnership. But then you have to look during the year and see what happens to the liabilities in the partnership. And if the liabilities go up, then your basis goes up by your share of that increase in the liabilities of the partnership. Conversely, if the liabilities go down, if they pay off some of the liabilities within the partnership, then you need to decrease your basis by your share of that decrease in the liabilities. So I wanted to walk you through, just give you guys a quick overview of basis. And now I think we can go ahead and launch our discussion of Chapter 10. And in this lecture, I'm just going to go through non-liquidating distributions and a quick discussion of Section 751. And if you have 751 assets, you'll have special rules that apply or that could apply to distributions, non-liquidating distributions. And that's where I'll end the lecture, and then we'll go through Problem 31, which covers non-liquidating distributions where 751 is in play. So first of all, what is a non-liquidating distribution? Well, a non-liquidating distribution is one that does not terminate the partner's interest. And we'll find later in the chapter that a liquidating distribution is one that is made, it could be one of a series or just one distribution which actually terminates the partnership and terminates the partner's interest in the partnership. So our example here of a non-liquidating distribution is this. Melissa is a 30% partner with ABC. That's the partnership. And her beginning basis in her partnership interest in ABC is $20,000. The partnership liabilities are $250,000. And we are to assume, by the way, that Melissa's basis of $20,000 is inclusive of her share of the partnership liabilities of $250,000, okay? After John is admitted, so a second partner named John is admitted to the partnership at some later date, Melissa's interest in the partnership goes down from 30% to 20%. So her partnership interest is diluted. And that happens sometimes when a new partner buys in. They may buy in, or you may have a number of partners buy in, and it actually dilutes all of the other existing, one or more of the existing partners' interests in the partnership. So it gets diluted. And in this case, hers goes down from 30 to 20%. So that dilution of partnership interest needs to be reflected in her basis. And if she has decreased her interest in the partnership, what do you think we need to do to her basis? Well, we need to decrease her basis by her decreased share of the liabilities in the partnership. So she doesn't own anymore, she doesn't get basis anymore for 30% of the liabilities. She only gets basis for 20% of the liabilities. And the way that you calculate that is by saying what's her decreased interest. So it's 30 minus 10%. So that's 10%, 30 minus 20% rather, and that's 10% decrease. And then you multiply that times the liabilities. So 10% times 250 is 25,000. So we need to decrease her basis by 25,000. Now, what else do we know about basis? Basis can never go below 0. But basis can, or rather, the capital account in the partnership of that partner can go below 0. So if basis and the capital account of Melissa in the partnership are equal, then her basis would be 0 after dilution of her interest, because $20,000 old basis minus a $25,000 decrease equals -5, but you're not allowed to go negative, so her basis is 0. However, in my facts, I'm telling you that the capital account equals basis, so that means her capital account is now -5, because her old capital account balance was 20, and then we subtracted from it 25,000 for the decrease in her share of liability. So her capital account would be -5, but her basis would be 0. And there's a rule in section 731 of the code that says, to the extent that you have a distribution in excess of basis, you have capital gain for the excess. And her excess distribution is $5,000, right? $20,000 basis minus a $25,000 distribution. That brings her, that distribution is in excess of her basis by $5,000. So she will have a gain that she needs to pick up on her tax return of $5,000. Now, the way that I explained this to your classmates who came last night, because some of them were having trouble with the minus thing, with the negative thing, and I said, think of it this way, you guys. You get, and you're going to see this in a couple more slides, when you need to pick up gain for some reason, if a partner has to pick up gain, you get basis for that gain. Because remember, positive items increase basis and negative items decrease basis. And there's a nice little chart in chapter 10 or in chapter 9 rather, that walks you through how to calculate basis. And you guys should refer back to that now and again to refresh your memory and to keep, yourself straight as you go through these problems. So if I was to actually just say $20,000 basis minus the $25,000 distribution, I would have a -5. And then that -5 represents the gain that she's going to have to pick up under section 731. And then that gain would increase her basis by $5,000 because that's the gain. So if you took the -5 and you added 5 to it, voila, you've got a 0 basis. So you're welcome to think of it like that if it helps you with the pluses and minuses, and it might. Now, a minute ago I said, in some cases, the partner might have to pick up a gain. And if they do, they get basis for that. Here's an instance where a partner might have gain. So there's a concept called pre-contribution gains or losses, and they abbreviate it here and call it PC gains or losses. And what a pre-contribution gain or loss is the difference between the fair market value of the property contributed by the partner minus the basis in that property to the partner. So if the partner contributes something other than cash, let's say they contribute a couch, which they had bought 5 years ago for $1,000, and that's their basis, by the way, in the couch is $1,000. Let's assume they haven't been depreciating it for some reason. So their basis is $1,000, but the fair market value is only $500. So they actually have a pre-contribution loss of $500 upon contribution of that couch into the partnership. And that's calculated as $500 fair market value minus the $1,000 basis. So that's a pre-contribution loss. Now, what do we do with that? The contributing partner must recognize that gain or loss if the partnership distributes that couch to any other partner within 7 years of the date of the contribution of the couch. So if within 7 years that couch is distributed by the partnership out to a partner other than the original partner who contributed the couch, that contributing partner has to recognize his realized pre-contribution gain or loss that he realized on contribution date. And by the way, he did realize a loss of $500 on the date of his contribution of that couch to the partnership. He just doesn't recognize it. And the reason he doesn't recognize it is that Section 721 tells you that contributions of property are non-taxable. So you might have a realized gain or loss of the property that you're contributing, because remember, you're giving it up. And normally a disposal of property results in a realization of gain or loss, right? Whatever we give it up, whatever we get for the property that we give up, minus the basis. So when we contribute that property to a partnership, we're essentially getting back an interest in the partnership. So the way that they calculate the pre-contribution gain or loss is by saying, well, whatever the fair market value of that couch was on the date of contribution minus the basis in that, we're going to call that the pre-contribution gain or loss. And that is realized, but it's not recognized under 721. But it will be recognized if it's actually distributed to some other partner within 7 years. Now, if the PC partner, I'll call him, the original contributing partner, has to recognize under this rule the PC gain or loss, then he gets to increase or decrease his basis, or rather he has to increase or decrease his basis by the recognized gain or loss. He increases it if he's recognizing a gain, and he decreases his basis in the partnership interest if he's recognizing a pre-contribution loss. And then likewise, the partnership increases that distributed partner's they increase the distributed property's basis by whatever the recognized gain or loss was by the contributing partner. So when they distribute that property out to some other partner within the 7 years, they go, oh, what's the pre-contribution gain or loss? That's in our case, it was a $500 loss. So they go, oh, that original contributing partner is going to have to recognize a loss, and they're going to have to decrease their basis. So the partnership also decreases the basis of the couch before they distribute it out to that other partner. So now the basis to the receiving partner, that other partner that gets the couch on distribution, his basis is going to be 1,000 minus 500, which is the decrease in the basis, equal to the recognized pre-contribution loss. Okay? Here's an example. Michael contributes land with fair market value equal to 7,000 and basis equal to 3. So here he's got a pre-contribution gain that he's realized of 7 minus 3 equals $4,000. Now, that's realized gain, but it's not recognized under 721. However, 6 years later, so we're under the 7-year rule, 6 years later, that land has a fair market value of 9,000, and it's distributed to another partner named Stephen. So at that point, Michael has to recognize the $4,000 pre-contribution gain, and he will increase his basis in the partnership interest by $4,000. So his original partnership interest when he contributed the land 6 years ago was $3,000. Because remember, when you contribute property in exchange for an interest in a partnership, the basis that you get in the partnership interest equals the basis of the property that you contributed. And the basis of that land 6 years ago to Michael when he contributed it was $3,000. So his basis in the partnership on day one was $3,000. Now he increases his basis to $7,000. So he increases it by $4,000. 3 plus 4 is 7. And then likewise, the partnership increases its basis in the land to $7,000 also. Because also remember, when Michael contributed that land 6 years ago to the partnership takes on a basis in that land equal to the basis that Michael had in that land before he contributed it. So the partnership increases its basis of $3,000 by the $4,000 pre-contribution gain that Michael recognizes in year 6, and that now their basis in the land is $7,000. And Stephen, who receives the land from the partnership, takes on a basis in that land equal to $7,000. And he doesn't, and they say at the end here, he doesn't have to recognize any gain or loss, which is true. Now you would think, oh, why doesn't he have a gain to recognize? Because the land's actually worth $9,000, but his basis is only $7,000. No, he doesn't have any gain or loss, so don't worry about the $9,000. It doesn't really bear it. It doesn't bear, it's irrelevant here. Okay. Another way in which the pre-contribution gain or loss can be recognized now, in this case, and this is under section 737, it's where any property in the partnership, and not the couch, doesn't have to be the couch, it's like some other property in the partnership is distributed to that partner who contributed the couch and has the realized but unrecognized pre-contribution loss sitting on his books, right? When the partnership distributes some other property to the pre-contribution partner, we'll call him the PC partner, and where the fair market value of that property is greater than the partner's basis in his partnership interest in the partnership, then there will be gain recognized by the PC partner equal to the lesser of the remaining PC gain, whatever the unrecognized PC gain or loss was, and sometimes some of that will get worn down. In more complicated situations, you may have some of the PC gain or loss still there and some of it was gone. So the lesser of the unrecognized PC gain or loss or the excess of the fair market value of the property over the adjusted basis of the partner's interest in the partnership. Now, when you look at the basis of the PC partner's interest in the partnership, you want to look at it after any cash that was distributed to that partner on that same day that the other property was distributed to him, which is triggering this 737 gain. So here's the example where they talk about it on the slide. We have Sergio, who originally on day one contributed $20,000 of cash plus land with a fair market value of $20,000 and a basis of $15,000. So he has a pre-contribution gain realized of $5,000 upon contribution of the land in exchange for a 30% partnership interest. Now that's on day one when he actually buys into the partnership. Okay. Now in some other year, we'll call it year 2, Sergio, who hasn't recognized his realized PC gain of $5,000 yet, Sergio receives distribution of $8,000 in cash plus some other property that has a fair market value of $45,000 and a partnership which has a fair market value of $45,000, okay? And in year 2, when he receives that distribution of the property, his basis in the partnership at this point is $30,000. So remember, on day 1, his basis in the partnership upon contribution of the $20,000 of cash and land with a basis of $15,000, his beginning basis in the partnership, assuming no liabilities existed in the partnership, was $35,000. 20 plus 15, or $35,000. Now in year 2, his basis in basis in the partnership interest has gone down to $30,000. Okay. Oh, I'm sorry. I messed this up, and I'm not going to try to cut the video, you guys. I'm wrong about the facts. Actually, the property that's distributed to him has a fair market value of $45,000 and a basis of $30,000 to the partnership, okay? And just remember that his original basis in the partnership interest was 20 plus 15 or 35. We'll go from there, okay? Oh, but what they don't tell you on this slide, I forgot about this on the lecture last night, what they don't tell you here in the slide, but actually the same example is in your text, so you can read it in the book, in the chapter. His basis in his partnership interest on the date of this distribution in year 2 is $40,000, okay, before distribution. So now what we have to do is do that calculation that I did. And what his 737 gain is going to be, that he's going to recognize, is going to be the lesser of the $5,000 PC gain, which is this amount right here, or $13,000, which is basically defined as the excess of the fair market value of the property that's distributed over his adjusted basis in the partnership interest after reducing that basis by any cash that he gets distributed. So his beginning basis was $40,000. They tell us in year 2 his basis in the partnership interest is $40,000. We have to reduce that by $8,000 of cash that he gets distributed, because distributions actually reduce basis, right? So now his basis in the partnership interest is $32,000. So the excess of the fair market value of the property distributed to him over his adjusted basis is 45 minus 32, or 13. The lesser of the $5,000 PC gain, or the 13, is 5,000. So he will have to recognize a gain under 737 of the code equal to $5,000. That will actually go on his return. And the character of the gain, and character means is it going to be ordinary gain or capital gain, follows the character of the PC gain property. So in this case, he contributed land, which was a capital asset to him. I'm going to assume it was. I'm going to assume that he held that land as an investment, so it would be a capital asset. And in that case, the realized PC gain was capital gain, or would have been capital gain if he had to recognize it. So now this $5,000 capital gain in year 2 that he has to recognize under section 737 is going to be capital. Okay? And we like capital gain, right? Why do we like capital gain? We like capital gain because then we might be able to absorb any capital losses that we realized during the year. We only get to deduct capital losses to the extent of capital gains realized in the same year. So we love capital gain, but we don't really like ordinary gain because it doesn't do us any good to have ordinary gain if we have capital losses. And if you can't use the capital losses, you have to carry them over to a subsequent year or carry them back to a prior year and try to use them. Okay? Now, the impact of that section 737 gain recognition is that the partner who recognizes the gain, gets to increase his basis in his partnership interest by the amount of 737 gain recognized, just like he gets to increase his basis by any pre-contribution gain that he recognizes, that he has to recognize because of that 7-year rule that we talked about. And then the partnership increases the basis in the property that had the PC gain. So remember, they still hold the PC gain property, the couch. They distributed some other property to the PC partner. So they will increase their basis in the property of the couch. In the couch, they'll increase their basis in the couch by the amount of 737 gain recognized by the PC partner. Okay, basis effects of distributions. When a partner receives property in a distribution by the partnership, the partner takes a basis in that property equal to the basis that the partnership had in the property. It's a carryover basis. And the basis in the partner's partnership interest is reduced by any cash distributed plus the basis of any property, other kinds of property distributed. And by the way, cash is property, right? But it's cash property. And then there's non-cash property. And non-cash property could be tangible personal property, like a couch. And why is it called personal property? Because it's not real property. It doesn't mean personal like you're using it in your personal business. It means that it's not real property. And tangible means you can touch and feel it. They could distribute an intangible asset. And an intangible is like something like a customer list or a workforce or goodwill or a trade name or a trademark or a patent. If those were distributed by the partnership, then the basis that the partner would take in that would be the basis that the partnership held in it. And then they would reduce their basis in their partnership interest by the basis of that property. Now, if the cash plus the basis in other property received by the partner exceeds his basis in the partnership interest before the distribution, then the excess distributed, the excess basis of the property distributed over his basis in the partnership interest needs to be allocated among the non-cash assets that were distributed to reduce their basis. Because why? Because our basis in the partnership interest can never go below 0. So the way we handle that is by saying, oh, what is the excess? I will reduce the basis of the non-cash property received by the excess. And now it'll have a lower basis. And that's how the IRS equates everything economically. This is a pictorial of what I just said. And what you do when you have and by the way, a current distribution is like saying the same thing as a non-liquidating distribution. And when you're doing a tax return for a partnership, you'll ask the partnership, the tax matters partner. There's a partner called the tax matters partner. He's the TMP, and usually it's the general partner. If it's a general partnership, it could be, anybody. But if it's a limited partnership, usually the TMP is the general partner. And they're the ones who, handle tax matters like this. So you would ask them, hey, did you distribute any property out to the partners in the current year? So if you did, then you'd have to go through this calculation here to determine what the effect of the distribution is on the partners' respective bases in their partnership interests. And by the way, the plural of basis is bases, for those of you who don't know that. Okay, so first of all, the partner reduces his outside basis. Now, OB is outside basis. And what is the outside basis? That's his basis in his partnership interest in the partnership. That's the other term for that. The other name for that is outside basis. We're going to call it OB here. So first, the partner reduces his OB by the amount of cash distributed. Then he allocates the basis of, he allocates his leftover basis, whatever's left in his partnership interest, to any inventory or receivables received in distribution first. And then he would add partnership bases in the rest of the distributed assets. He adds those up together. And if those partnership bases are greater than his outside basis after reducing the outside basis by cash and the basis of any inventory or receivables received, then that difference, that excess, is allocated to decrease the carryover bases of the other non-cash property other than inventory or receivables that's received. First, you would allocate the decrease to assets where the fair market value has declined. So in other words, assets with built-in losses where their fair market value upon distribution is actually less than the basis of that property to the partnership. And then you allocate the remaining decrease based on relative bases after step 2. And in the book, there's an actual example of how you do this. It's a big table with columns and everything. And you guys should use that to solve your problem, because I think I did give you a problem where you have to go through and do this. It's kind of fun. It's not that hard, but it's very mechanical. So you have to do the math in the steps like they're saying here to make it work under the rule in the code. Now, that first situation is the situation where the partner's outside basis is actually less than the bases in the partner distributed, in the property distributed. But you could have a case where the partner's outside basis is actually greater than altogether than the sum of all the bases in the property distributed. So if that's the case, where you have greater outside basis than all of your property distributed, then what you do is, first of all, you reduce your outside basis by the amount of cash distributed. Then you allocate the basis of the inventory and receivables to the partnership. That basis carries over to the partner. You allocate, you decrease your outside basis by those two properties. Then you add the bases in the rest of the distributed assets. And then again, you basically go through to determine whether you've got a decrease that you have to allocate or an increase. And again, the book goes through this and talks about it. And I think they actually have an example where it's an increase or a decrease. So just make sure that you follow the mechanics of the steps and you should be okay. Now, what do you do about holding period and character of the property? So what is holding period? Holding period is how long someone has held a piece of property. And we care about holding period because depending upon how long you've held property, it could, when you dispose of that property, let's say the property is a capital gain asset, then if you held it for more than 1 year, you'll have a long-term capital gain or loss. But if you held it for less than 1 year, you'll have a short-term gain or loss. So that's just one example of where holding period matters. And it's also an example of where character of the property matters, because if the character of that property that's distributed to us is capital in nature, then when we dispose of the property, it's going to result in a capital gain or loss. Now, if we dispose of it and we have a capital gain, we're all happy, right? Because now if we have any capital losses realized in that same year, we can offset those losses by that capital gain. But we're probably not too happy if the character has to get tacked on, i.e. carried over to us upon distribution by the partnership, and we dispose of the property later and we have a capital loss, we're probably going to be like, oh, dang, I don't really want this to be a capital asset because it's depreciated property, and when I sell it, I'm going to have a capital loss, and I might have to sit on that capital loss for a few years until I have capital gain on a tax return, where then I can carry that capital loss over and offset the capital gain by the capital loss. Because otherwise, those capital losses just sit there unused, and that means that you're not reducing your taxes by the tax effect of those capital losses, which is what we all want. We want to reduce our taxes. That's why we like losses of any kind. So the rule is this: the holding period of the distributed property tacks on from the partnership, meaning whatever the holding period was of the property on the date of distribution, that holding period becomes the starting holding period of the partner who now holds the property because he got distributed the property. So if it's been held by the partnership for 2 years, and then at the end of year 2 it's distributed to the partner's beginning holding period for that property is 2 years. It's like he had already held it for 2 years. That's what that means. I don't even know why they have the second bullet, but they have a bullet saying the length of time that the partnership ownership is owned by the partner is irrelevant, and that's true. I don't think they needed to say that, though. And then the third bullet says that if the property distributed is ordinary income property, it stays ordinary income property even if it's held for more than 1 year. So that tacks on to the partner receiving the property, and it becomes it stays ordinary income property. Well, that's okay if we realize a loss on it when we dispose of it in a subsequent year, because we like ordinary loss. But it's not so good if we have a gain on it. If it was appreciated property when it was distributed to us and then we want to dispose of it, we would have an ordinary gain, and we don't like that. So there's an exception to that ordinary income rule. If the partner owns the inventory, and the ordinary income rule exception only applies to a distribution of inventory, and inventory is ordinary income property, okay? So know that about inventory. It's not a capital asset, it's ordinary income property. So if the partner owns the inventory that's distributed to him for at least 5 more years, or for more than 5 more years, then upon sale of that inventory, the character of the gain or loss depends upon the character in the hands of the partner. So even though that inventory is an ordinary income asset to the distributing partnership, it could end up changing nature in the hands of the partner, because if you take an instance where the inventory is, let's say that the distributing partnership distributes land to the partner, and the partnership was in the, they're in the business of buying land and holding, they have inventory of land that they hold and then they sell it to people. That actually is not a capital asset to that partnership. It's actually an ordinary income asset to the partnership, and that land is considered inventory. But when they distribute it down to the partner, if the partner's just holding that land as an investment and he doesn't have an operating business like the partnership did, whereby he buys up a bunch of parcels of land and then sells them to people as, you know, as part of his trade or business, then that land becomes a capital asset in the hands of the partner. But this rule says that in order for it to take on capital asset nature, character, it has to be held for more than 5 years by the partner before he disposes of that inventory. Okay? Now, if we have a non-liquidating distribution, where there are 751 assets, Section 751 assets involved, we could end up having a situation where the distribution is not treated as a distribution and handled as a distribution in the way that we just discussed. It could actually be treated as a sale instead. And that's what is covered in problem 31. But first of all, we need to understand what the definition of a Section 751 asset is. And Section 751 assets are defined as unrealized receivables and inventory, okay? And further, the definition of an unrealized receivable includes AR, accounts receivable, also Section 1245 or 1250 recapture items, and also other kinds of recapture items. And it discusses this in the book in more detail. So read the text about this. 751 assets also include inventory. And the definition of inventory for just Section 751 purposes is this. The inventory must be substantially appreciated. And the definition of what substantially appreciated means for 751 purposes only is that the fair market value of the inventory is greater than 120% of the basis of the inventory to the partnership, okay? If you have a situation where the partnership owns both 751 property and non-Section 751 property, and they make a distribution of either the 751 property or of non-Section 751 property, like cash, then you need to go through a step-by-step procedure to determine what the tax consequences are going to be of that distribution. And that's what this pictorial is trying to show you. And at this point, we're going to go through the problem. So I'm going to, I'll go through the slide real quick. So if you have that situation that I just mentioned, then this type of an exchange is considered to be a deemed sale instead of a distribution. And the gain or loss on the deemed sale is fully recognized. The character of the gain or loss is based on the character of the property that's deemed sold to the partner or to the partnership, depending on which way it's going, and you'll see this in the problem. And the seller, and they put that in quotes because, again, it's a deemed sale, the seller of the 751 assets has ordinary income or loss, okay? Okay, we're going to stop now, and I'm going to do another video, I think. I'm going to do a separate video with problem 31. So talk to you guys later.